The absolute worst thing that you can do if you're flipping houses and making great money is spend all of your profits, because a lot of people, especially those inexperienced and starting out, miss this number one thing, and that's taxes. It's the silent killer of all of your profits if you don't know how to plan right, and you could even end up owing money at the end of the year to the government if you don't strategize correctly. So in today's video, I'm breaking down everything you need to know about house flipping taxes and how to lower your tax bill and optimize how much cash you keep in your bank account. By the end of this video, you're gonna know how to keep more of your hard-earned cash in your pocket and avoid any surprises that come your way this tax season. So hey guys, welcome back to the channel. If you're new here, this channel is all about helping you make smarter moves in house flipping, real estate, business, and overall entrepreneurship. My name is Jeff Kudlotz, AKA Jeffrey Dollars, and I am a real estate investor and house flipper, and also the creator of the Stealth Wealth Profit System, which focuses on creating and maximize value for the least amount of money possible. Since 2016, I've flipped over 350 homes. I've done over $50 million in real estate transactions, and my house flipping business does between $100,000 and $200,000 each and every month. If you guys want proof of that, if you want to check out exactly what I'm talking about, check out my show called Real Estate Riches. It's the show here on YouTube, the only program out there that shows you the good, the bad, and the ugly, and no bullshit about flipping houses and how you can be successful at it. So don't forget to subscribe to the channel so you don't miss out on these episodes when they come out each and every week. So it's very important to understand the tax implications when it comes to house flipping. So real estate is classified as what's called a capital asset. So profits from your home purchases are actually taxed under the capital gains rule. Now there's short-term capital gains and there's long-term capital gains. Short-term is any asset that you hold up to 365 days. Now, when it's taxed at long-term capital gains, that means 366 days and above. The downside to short-term capital gains is that it's actually taxed at the same rate as your income tax, and this applies to properties that are also held for less than a year. Now, the long-term capital gains are taxed at a lower tax rate, but you do have to hold them for longer than a year. So when the IRS looks at house flippers, they classify us as what's called a dealer. Now, what does a dealer mean? Well, that just means that our profits that we make are taxed as ordinary income and not capital gains. So you being the house flipper or the dealer, your profits are subject to self-employment tax, which today in 2024 is 15.3%. So 15.3% of your profits are going to be taxed as a dealer. Now there's specific qualifications that come to the IRS when they classify you as a dealer or an investor. So an investor typically holds properties for the long time. They make an investment in the property. Now the stipulation when you're being classified by the IRS is the frequency of transactions. So the more frequently you buy and sell, this leans towards that dealer classification, which if you're a successful real estate house flipper, you are going to frequently have a lot of transactions. Now, another technique that the IRS uses to classify house flippers as dealers is that they look at the purpose of the purchase. Now, was the property purchased for resale or was it meant to be held long-term? This is how they classify you as a dealer or an investor. The IRS also looks at the extent of the property improvements. So if you are making significant improvements, this also indicates that you have what's called dealer activity. Another technique that they use is that they look at the use of the property. Was it ever listed as your primary residence, or was it ever listed as a long-term hold? They also consider the level of advertising that you do. So a heavy level of advertising points to you having a dealer status as a house flipper. So if you're unsure exactly how the IRS is going to classify you as a real estate investor or a dealer, go ahead and consult with your CPA with real estate experience to accurately assess your status. So it's also important when you are strategizing on how to optimize and lower your tax bill. You also want to conduct pre-flip planning and consult your CPA for any tax strategies that you can do before you buy the property. Now, this includes setting up your business structure in your entity, because different entities are taxed at different rates. Now, me personally, in my business, I have what's called an LLC, which stands for Limited Liability Company, but I am also taxed as an S Corp because I am able to use a portion of my income as a salary. Now, LLCs are popular for house flippers and real estate investors because they offer personal liability protection and pass-through taxation. Now, pass-through taxation just simply means that you avoid being double taxed personally and through your LLC. Now, an S Corp allows you to pay yourself as a W-9 contractor or even a W-2 employee with the profits treated as ordinary income. Now, the difference between an LLC and an S Corp is that some flippers choose to set up an LLC and elect to be taxed as an S Corp for the best of both worlds. So they have the protection of a limited liability company, but they also have the tax-saving advantages of an S Corp, which is how I am set up currently in my business. Now, you can create what's called a series LLC. Now, this simply means that you can put different houses in different series of your main LLC, thus reducing your overall liability. Now, here's an example. If you have house flipping company ABC LLC, then you can create house flipping company ABC LLC A, and then ABC LLC B. So you can have different series within your LLC so that you lower your overall liability. Now, this is good because if you have contractors that are working on different properties and one of them, let's say, hurts themselves and they sue you, then they are only able to go over the assets that are in that specific series. But again, this isn't legal advice, this isn't financial advice, so always consult with your CPA and seek advice from them before deciding on your business structure. This also helps you to ensure that it aligns with your personal tax strategy. So we talked about what to do before you actually purchase the property and before you actually start the house flip. Now let's dive into exactly what you should do during the house flip and what type of tax deductions and credits you should take advantage of. Always look for deductions when it comes to your house flipping business and determine what capitalized costs and deductions you are able to incur to lower your tax bill. You're able to deduct certain things like professional services, whether it's legal fees or CPA fees. You can deduct any office expenses and even any software costs. If you have travel expenses or you have different expenses related to going to and from your properties or just operating your business in general, those are also deductions that you should take advantage of. Now, the most obvious one is that you can deduct all of your renovation costs. And then if you have a loan on the property, you're able to deduct the interest, any taxes or mortgage payments from your overall expenses. Now, it's very important to track all of these expenses, and that's where a bookkeeper comes into play. If you have detailed records of all of these expenses, including any receipts or your purchase orders, this will help provide proof at the end of the year so that you can back up your income deductions from your tax bill. There's also certain tax credits that you can go after during your flips if you have energy efficient improvements like solar panels or heat pumps or any type of energy efficient appliances. All of those apply to having tax credits. Talk to your CPA and see exactly what tax credits are available to you that will reduce your tax liability. Other strategies that I use to lower my tax bill for the end of the year is any depreciation on long-term rental properties that I hold. So I use a strategy to where I use my active income to create passive investments. I simply take profits from one house flip and then I put that into a long-term asset and then hold it as a rental property. So if you hold a property as a rental before selling, you can actually claim depreciation on that building over time. And this is going to reduce your taxable income for each tax bill. The concept here to this strategy is that you should always be taking money off the table and putting it into assets or vehicles that will grow that money even further. So let's say, for instance, you make $50,000 on a house flip. If you take that money and you go buy a rental property, you are now able to depreciate the rental property from your active income, and then that will reduce your tax bill at the end of the year. But one thing to keep in note is that depreciation recapture is actually taxed when you actually sell the rental property, but the long-term benefits clearly outweigh the short-term benefits. Another strategy you can use is what's called a 1031 exchange. Now, what this does is it allows you to defer capital gains taxes by reinvesting the profits that you have into another property. Now, there are certain stipulations when it comes to the 1031 exchange because you have to hold the property for longer than a year. This works best if you're planning to hold the next property for your investment purposes and if you're planning on holding it long term. You can also deduct if you have a home office, you can run your house flipping business from your office and claim a portion of your home expenses as a business deduction. This includes utilities, mortgage interest on your primary home, and then any repairs that you make to your house. Another way that you can lower your tax bill is contributing to your retirement accounts and making sure that you maximize all of these contributions each and every year. It's very advantageous to set up retirement accounts like a SEP IRA or a solo 401k so that you reduce all of your taxable income. All of these contributions are tax deductible and significantly lower your tax liability while at the same time building your retirement savings. Another way to lower your tax bill from your house flipping profits is to donate to a charity and then you deduct the value of your donation from your taxable income. This strategy is actually very useful if you've had a very profitable year and you want to offset some of those gains. So you get a good feeling by donating to a charity, but you also get a good feeling by lowering your tax bill. Okay, so now we talked about what happens during the house flip, but what about actually when the house flip sells? So these are going to be the tax events of what actually happens once you actually close on the sale. So now you have to calculate your gross profit. And to simply do this, you just subtract the purchase price from the resale price and then deduct any type of business expenses related to and fixing up the property. It also might be a good idea to check with your CPA is that you should pay your taxes due when the property is actually sold so that you don't have a very large tax bill at the end of the year. Now, if you overpay for your taxes and you're able to reduce your income to zero, you may be able to get a refund once your tax bill is finished. Now, one thing to be very mindful of when it comes to filing taxes is that all of your income from the previous year must be reported on your tax return. One other strategy that you can talk about to lower your tax bill is sending in quarterly estimated payments. So if you're expected to owe $1,000 or more at the end of the year, then you can actually make quarterly payments each and every quarter to not have such a huge tax bill at the end of the year. Always make sure that you file on time, and if you are not going to be able to file on time, make sure that your CPA files for a tax extension. So each state has different income taxes, and some have a very high rate and some don't have any at all. Now, it can vary state to state, so check with your CPA on exactly what your state income tax rate is, because this will have a very big impact on your profitability and affect your overall profit margin. My advice is research your state-specific tax laws and consult with your CPA to make sure that you're staying compliant while also maximizing your profits. No matter what strategy you implement when it comes to lowering your tax bill, it's always, always, always best to pay the professionals. They specialize in these areas on how to lower your overall tax bill, and they have a role in navigating the complexities of all of these house flipping tax issues. I pay my CPA stupid amounts of money to lower my tax bill each and every year. In fact, I actually get refunds at the end of every year because of the deductions that she advises me on to take in my house flipping business. Now, when you're looking for the right CPA, you want to look for somebody with real estate experience, real estate background. You want to make sure that they are able to navigate and look for all of the deductions that you can legally take advantage of in real estate. Bottom line, the best CPA that you can find will be able to maximize your deductions while helping you also avoid any type of penalties. Pro tip here is engage a CPA early in your house flipping journey to set up any proper tax strategies from the start so that you can begin to take advantage of these deductions and lower your tax bill each and every year. So we talked a lot about how to set up your entity, proper deductions that you can take, but it's very important to understand and manage your taxes so that your tax bill each and every year will be as low as possible. It's a lot of fun to make a lot of money in house flipping, but if you don't take tax planning seriously and protect your profits, all of that is going to be for nothing. And you don't want that, I don't want that, so talk to a CPA, get serious, and find out exactly how you can be properly protected and how you can optimize all of your tax strategies. So thanks for watching, guys. If you found this video helpful, hit that like button and subscribe for more insider tips on flipping houses and lowering your tax bill even further. Be sure to follow me on other platforms. You can look up Jeffrey Dollars on every social media channel. If you want a free profit calculator that takes into account all aspects and expenses on a house flip, click the link in the description below. It's completely free and it's going to level up your deal analysis game. I absolutely promise. And if you guys have questions about taxes or just house flipping in general, drop them in the comments and I will get back to you personally. So that is the end of the video. I hope you enjoyed it and I will see you on the next one.